My friends, there is a quiet mistake being made in homes across Australia right now, and for some seniors, it could mean a smaller age pension payment in 2026 without them understanding why. It is not a scam. It is not a new tax. It is not a fine arriving in the mail. It is something far easier to miss. It is the money sitting in your bank account, your savings account, your term deposit. The extra cash you have kept aside for emergencies, medical bills, home repairs, funeral costs, or simply peace of mind. Many older Australians look at that money and think, this is just my safety net. I am not earning a wage. I am not doing anything wrong. Surely this cannot affect my pension very much. But Centrelink does not only look at whether you are working, it also looks at your assets, and it looks at what your financial assets are deemed to earn. That means the balance sitting in your bank account can affect both the assets test and the income test used to calculate your age pension. And here is the painful part. You may not receive a dramatic warning. You may not see an obvious red flag. Your pension can simply reduce, fortnight by fortnight, because your recorded bank balance is no longer accurate, or because your savings have crossed a level that changes the way your pension is assessed. That is why today I want to walk you through the Centrelink bank balance mistake that every Australian senior should understand in 2026, especially if you receive a full or part age pension, live on fixed income, or have recently moved money between accounts, received an inheritance, sold an asset, or built up savings over time. Because this is not about having too much money. It is about not realizing how Centrelink counts the money you already have. And by the end of this video, you will understand three things clearly. First, how your bank balance can reduce your age pension. Second, the specific mistakes seniors make when their savings increase or change. And third, what you should check now so you do not quietly lose money you may have been counting on every fortnight. Now, let me begin with a simple story. Imagine a woman named Margaret. She is 74 years old. She lives alone in a modest home she bought with her late husband decades ago. She receives the age pension, watches her spending carefully, and has always believed she is doing the right thing financially. Over several years, Margaret slowly builds up her savings. She is careful. She does not spend freely. She keeps money aside for dental work, unexpected repairs, and the rising cost of living. Then, after selling an old car and receiving a small family repayment from one of her children, the balance in her main bank account rises noticeably. Margaret does not think much of it. She is not hiding anything. She is not trying to cheat the system. She simply assumes Centrelink already knows enough about her circumstances, and that a bank balance is just a bank balance. Months later, she notices her pension payment has changed. It is lower than expected, not by hundreds in one go, but enough to make groceries tighter, power bills more stressful, and every fortnight feel a little less secure. When she finally checks, she learns the issue was not employment income. It was not rent. It was not a new law she had failed to follow. It was her financial assets. Her recorded information no longer matched the money she was actually holding, and once the assessment changed, her pension amount changed with it. Pause there, because this is the moment many seniors misunderstand. Centrelink does not view bank money as invisible, just because it is sitting quietly in an account. Bank accounts are financial investments for age pension purposes. Savings accounts, credit union accounts, term deposits, cash, and several other forms of financial assets are counted. And Centrelink uses those assets in more than one way when working out your pension. That means a larger bank balance can matter in two separate directions. One, it can increase your total assessable assets. Two, it can increase your deemed income. And Centrelink applies whichever test results in the lower pension rate. That distinction is critical, because some pensioners think, my bank only pays a little interest, so surely it barely matters. But Centrelink does not always assess only the actual interest you earn. Under deeming rules, It assumes your financial assets earn a set rate of income, whether your bank pays that exact amount or not. As of 2026, the first part of a single pensioner's financial assets is deemed at one rate, and amounts above that threshold are deemed at a higher rate. Couples are assessed using combined financial assets. The deemed income is then added into the pension income test to determine whether your payment should reduce. That is where the bank balance mistake becomes dangerous. A senior may focus only on what the bank actually paid in interest, while Centrelink is working from deemed income rules and total assessable asset values. Those are not always the same thing. Now, let me say something plainly. This does not mean having savings is bad. It does not mean you should panic and spend money recklessly. It does not mean every extra dollar in the bank automatically slashes your pension. But it does mean this: if your bank balances change, and Centrelink's records do not reflect that change, you can end up with the wrong pension assessment. And if your assets move above the relevant free area, your payment can start to reduce. That is the part too many people discover late. And before we go further, if this channel helps you understand the rules that affect Australian seniors in plain English, subscribe now and turn on notifications. These systems are complicated by design, and one clear update at the right moment can save you from months of confusion and unnecessary financial stress. Now, here is the blunt truth. The most common mistake is not that seniors have money in the bank. The mistake is assuming that once Centrelink has your bank details, you never need to think about those balances again. That assumption can cost you. Centrelink expects pensioners to tell them about relevant changes in circumstances, and this includes changes in financial assets. If your overall financial asset value rises by a reportable amount, you may need to update those details. Services Australia has also made clear that people receiving payments must tell Centrelink when there are changes to bank account balances. Think about how easily this can happen. You move money from a transaction account into a higher interest savings account. You close one term deposit and open another. You receive proceeds from selling a car, caravan, boat, or second property. You are paid back money by a relative. You receive an inheritance. A matured investment lands in cash. You hold on to an unusually large balance for renovations, aged care planning, medical procedures, or helping family. Each of those events can change the amount Centrelink counts as your financial assets. And here is the uncomfortable part. Even when the money is intended for something reasonable, Centrelink may still count it while it is sitting there. That is why seniors get caught. They do not think of themselves as wealthier. They think of themselves as prepared. They do not think they have increased assets. They think they are keeping money aside for a purpose. They do not think they are earning more income. They think interest is still small, but the Centrelink assessment looks at the rules, not the intention. Now ask yourself honestly, if you checked your Centrelink financial asset details today, would the bank balances shown there match reality? Not roughly, not close enough, not what they were 6 months ago. Would they match what is actually in your accounts now? Because if the answer is no, that is the first warning sign. And this matters even more in 2026 because age pension, limits, cutoff points, and deeming settings are specific. They are not vague guidelines. There are exact thresholds. There are exact assessment rules. There are exact reductions once your assets or assessable income move above certain levels. For example, age pension asset limits depend on whether you are single or partnered, and whether you own your home or not. Once your assets are above the full pension asset free area, your pension begins to reduce. If your total assessable assets move high enough, your part pension can eventually reduce to zero. That is not meant to frighten you. It is meant to make the system visible, because invisible rules are the ones that do the most damage. A pensioner can look financially careful on the outside and still be making decisions with outdated assumptions on the inside. And one of the most outdated assumptions is this: money in the bank is harmless because it is not income. Under Centrelink rules, That is not how it works. Your bank balance can affect your pension because it is an asset, and through deeming, it can also be treated as producing income for assessment purposes. Now, here is a pattern that catches many people off guard. A pensioner may think their pension fell because Centrelink just reduced it again, when in reality, the issue may be that their asset position changed. Sometimes the change is not obvious. Sometimes it happens after a once off event. Sometimes it happens slowly because savings accumulate. Sometimes it happens because a couple's finances are assessed together, and one partner forgets that combined assets matter. This is especially important for couples. If you are partnered, Centrelink generally looks at your combined income and combined assets, not just what is in your own personal account. That means money sitting in your spouse's account, shared savings, or a joint term deposit can affect both pension assessments. And let me stop you there, because this is where people lose the thread. The bank balance mistake is not just about failing to report a large lump sum, it is also about failing to understand how Centrelink sees the entire household financial picture. A single pensioner may focus on their own account. A couple may focus on my money and your money. Centrelink focuses on the assessable position under the rules. That difference matters. Now, there is another detail that sounds technical, but I want you to stay with me because it explains why this topic is so important. The age pension is assessed under both the income test and the assets test. Centrelink calculates both. Then the test that results in the lower pension is the one that applies. This means you cannot safely assume my assets are okay, so I am fine, without also thinking about deeming and the income test. And you cannot safely assume my deemed income seems manageable, so I am fine, without thinking about the total value of your assets. Both sides matter, and bank balances sit right in the middle of both. That is why I call this a mistake rather than a loophole or a trick. There is no clever hack here. There is only understanding versus ignorance. If you understand it, you can plan. If you ignore it, Centrelink plans for you. Now pause and think about your own situation. Have your savings increased since the last time you updated Centrelink? Have you opened or closed an account? Have you transferred a meaningful amount into a term deposit? Have you recently received sale proceeds, a gift, repayment, inheritance, or a large refund? Have you assumed that because the money is temporary, it does not matter? If so, you are exactly the person who needs to pay attention, because temporary money can still affect a current assessment while you hold it. And this is where I want to make something crystal clear. The mistake is not preparing for emergencies. The mistake is not saving carefully. The mistake is not being financially responsible. The mistake is failing to connect those savings with the rules that decide your pension. Too many seniors are still thinking in household terms, while Centrelink is assessing in policy terms. Household logic says, this is rainy day money. Centrelink logic says, this is a financial asset with assessable value. Those are not the same lens. And when you do not understand which lens is being used, you make decisions that feel sensible but create consequences you did not expect. That is why this video matters. Because by the time many people notice a payment reduction, the confusion has already set in. They start wondering whether there was a government cut, a payment error, or a secret change they missed. Sometimes there has been a policy update, but sometimes the issue is much closer to home. Sometimes the real trigger is sitting in the savings account they stop thinking about. Because by the time many people notice a payment reduction, the confusion has already set in. They start wondering whether there was a government cut, a payment error, or a secret change they missed. Sometimes there has been a policy update, but sometimes the issue is much closer to home. Sometimes the real trigger is sitting in the savings account they stopped thinking about. And once you understand how that happens, the entire Centrelink assessment system starts to look very different. And once you understand how that happens, the entire Centrelink assessment system starts to look very different. Because for many seniors, The real danger is not one giant financial event. It is a series of ordinary, sensible decisions that quietly change how Centrelink sees your position. You save a little more because prices are rising. You move money into a better savings account because your old account is paying almost nothing. You receive a lump sum that you intend to use later. You keep a larger buffer because you are worried about aged care, health care, or the cost of repairs around the home. None of that feels reckless. In fact, it feels responsible. But if those balances are not updated, or if you do not understand how they affect the income and assets tests, your pension can be assessed differently from what you expected. And this is where one of the biggest blind spots appears. Some seniors assume that because Centrelink has access to information, they will automatically fix everything themselves. They think, surely if my bank balance matters, they already know. That is a dangerous assumption. You are still responsible for reporting changes that affect your payment. Centrelink may review information, may ask for updates, and may compare records, but that does not remove your obligation to keep your details accurate. That means the burden sits with you, not because the system is kind, not because it is simple, but because that is how the rules work. Now let me make this practical. Suppose your bank balance was once modest. You received the age pension, and your savings were recorded correctly at the time. A year passes, then another. During that period, you spend less than expected. You sell a car. A term deposit matures. A relative repays money they owed you. Your account balance is now meaningfully higher than when Centrelink last had accurate figures. If you have not updated that information, your record may be stale. And if your pension is later reassessed, you may suddenly face one of two problems. The first problem is that your ongoing pension amount may fall. The second problem is that Centrelink may decide you were overpaid if your actual circumstances should have resulted in a lower payment earlier. That second part is what many people fear most, and rightly so. A reduction hurts. A debt is worse, because once a debt notice appears, the stress multiplies. People start wondering whether they did something wrong, whether they will be punished, whether they have to repay money they already used for ordinary living costs. And often, the truth is much less dramatic but still serious. They did not set out to mislead anyone. They simply failed to understand that a changing bank balance was not a harmless private detail. It was something that could affect an age pension calculation. Now stop for a moment and think about how many seniors are vulnerable to this exact mistake. People who do not use MyGov regularly, people who hate paperwork, people who keep one old Centrelink letter in a drawer and assume nothing changes unless another letter arrives, people who trust that if there is a problem, someone will call, people who have lived carefully for decades and believe the system will naturally recognize that. That is not how the system works. The system rewards accuracy, not good intentions. And that is why this subject matters, because the bank balance mistake is boring on the surface, but expensive in real life. It does not sound dramatic enough for dinner table conversation. It sounds like admin. It sounds like paperwork. It sounds like one of those jobs you will get to later. But later is often where the damage begins. Now let us talk about the different ways this can affect retirees, because not every pensioner is exposed in the same way. A full pensioner with relatively low assets may have more breathing room. A modest increase in savings may not immediately change their payment, but that does not mean reporting no longer matters. Accurate records still matter, and larger increases can eventually affect the calculation. A part pensioner is usually more exposed. Why? Because they are already closer to the line. Their pension is already being reduced due to income, assets, or both. So an increase in financial assets may push their payment down further, sometimes faster than they expect. And someone who is near a cutoff point is in the most sensitive position of all. A change that seems manageable in household terms can matter significantly in Centrelink terms. This is why two retirees can make the same financial move and experience completely different pension outcomes. One may barely notice a change, another may see a real reduction, another may risk losing eligibility for part of their payment. The rules do not impact everyone equally. They depend on your broader circumstances, including whether you are single or partnered, a homeowner or non homeowner, and how close you already are to the relevant income or asset limits. But the mistake itself is universal. Assuming your bank balance cannot matter is wrong. Assuming Centrelink will automatically keep it accurate without you checking is wrong. Assuming a temporary lump sum does not matter because you plan to spend it later is wrong. And assuming that because you are not rich, you are not exposed to assessment changes is also wrong. That last one deserves attention. Many seniors hear the word assets and think of investment properties, large portfolios, or serious wealth. They do not think of their own savings account. They do not think of a term deposit. They do not think of cash they built up over years of careful living. But under Centrelink rules, financial assets are not limited to what ordinary people call investments. Bank accounts, term deposits, cash holdings, shares, managed investments, and other financial products can all form part of the assessment. That means a retiree who says, I do not have investments, just savings, may still be talking about accessible financial assets in Centrelink language. That difference in language creates confusion, and confusion creates mistakes. Now, let me give you another scenario. Imagine a married couple, John and Helen. John handles most of the banking. Helen receives the pension too, but she rarely checks the details. They have several accounts between them: a daily spending account, a savings account, a small term deposit, and an account John opened after receiving proceeds from selling some personal items and an older caravan. They do not think of this as complicated. To them, it is just family money sitting in different places. But Centrelink does not assess their finances by emotional ownership. It looks at combined assessable assets and income under the rules that apply to couples. If one partner forgets to report a new account, or if balances increase significantly and nobody updates the details, the assessment can become inaccurate for both. That is the kind of mistake that happens not because people are dishonest, but because they manage money informally, while Centrelink assesses money formally. And the more accounts there are, the easier it is to miss something: a forgotten credit union account, a term deposit rolled over, a joint savings account that grew after interest was paid, an emergency fund that became larger than expected, a deceased partner's account that was transferred, an inheritance temporarily held in cash. Each item feels separate in real life. Centrelink may look at the total picture. Now, here is the pattern interrupt that matters most. Do not confuse "I have a reason for holding this money" with "Centrelink will ignore this money." Those are not the same. You may be holding funds for a roof repair. You may be planning a bathroom modification for safety. You may be saving for a replacement car. You may be preparing for medical procedures. You may be keeping money because you are scared of becoming dependent on your children. All of those reasons are understandable. But unless a specific rule says otherwise, money sitting in your account can still be counted during the time you hold it. Your purpose may be sensible. The assessment may still change. That is why delaying a financial decision can sometimes produce consequences people did not expect. Not because they did anything foolish, but because they did not understand the timing. And timing is a bigger part of the pension system than most retirees realize. The date money arrives matters. The date an account changes matters. The date you report it matters. The date Centrelink reassesses your payment matters. You cannot manage pension risk properly if you only think in general terms. You have to think in specific events. What changed? When did it change? Has Centrelink been told? Do the records now reflect reality? That is the discipline.